Okay, reading 52, Introduction to Fixed Income Valuations, Learning Outcomes. The candidate should be able to calculate a bond's price given a market discount rate to identify the relationship among the bond's price, coupon rate, maturity, and market discount rate. Define spot rates and calculate the price of a bond using spot rates. Describe and calculate the flat price, accrued interest, and full price of a bond. Describe matrix pricings, calculate and interpret yield measures for fixed rate bonds, floating rate notes, and money market instruments. Define and compare the spot curve, yield curve on coupon bonds, par value curve, and following curve, and forward curve. Define forward rates and calculate spot rates from forward rates from spot rates, and price the bonds using forward rates. Compare, calculate, and interpret yield spread measures. Introductions. Globally, the fixed income market is a key source of financing for both businesses and governments. In fact, the total market value outstanding for corporate and government bonds is significantly larger than equity securities. Similarly, the fixed income market, which is also called the debt market or bond market, represents a significant investment opportunities for institutions as well as individuals. Pension funds, mutual funds, insurance companies, and sovereign wealth funds, among others, are major fixed income investors. Retirees who desire a relatively stable, low income stream often hold fixed income securities. Clearly understanding how a valuable fixed income security is important to investors, issuers, and financial analysts. This reading focuses on the valuation of traditional option-free risk fixed rate bonds, although other debt securities such as floating rate notes and money market instruments are also covered. Section 2 discusses usually what the sections talk about. Bond prices and the time value of money. Bond pricing is an application of discounted cash flow analysis. The complexity of this bond pricing depends on the particular bond's features and rates used to do the discounting. This section starts with using a single discount factor for all future cash flows and concludes with the most general approach to bond valuation. The general approach to bond valuation is to use a series of spot rates that correspond to the timing of the future cash flows. Bond pricing with a market discount rate on the traditional option-free fixed rate bond. The promised future cash flow are a series of coupon interest payments and repayments of the full principal and maturity. The coupon payments are on regularly scheduled dates. For example, an annual payment bond might pay interest on 15 June of each year for 5 years. The 5 coupons typically is paid together with the full principal on the maturity date. The price of the bond at issuance is the present value of the promised cash flows. The market discount rate is used in the time value of money calculations to obtain the present value. The market discount rate is the rate of return required by investors to given the risk of the investment in the bond. This is called the required yield or the required rate of return. For example, suppose the coupon rate of the bond is 4% and the payment is made once a year. If the time to maturity is 5 years and the market discount rate is 6%, the price of the bond is 91.575 per 100 of par value. This par value is the amount of principal on the bond. The final cash flow is 104, is the redemption of the principal of 100 plus the coupon payment for the date. The price of the bond is the sum of the present values of the 5 cash flows. The price per 100 of par value may be interpreted as the percentage of par value. The par value is of the $100,000 US. The coupon payments are $4,000 each year, and the price of the bond is $91,575. Its price is 91.575 of par value. So this makes a lot of sense. This bond is trading at the premium at this example because the price is above the par value. If another 5-year bond pays 6% annual coupon, and the market discount rate is still 6%, the bond will have a par value of exactly 1x or 100%. So which is the same amount. or 0% a return. The coupon rate indicates the amount of issuer promises to pay the bondholders each year in interest. The market discount rate reflects the amount investors need to receive in interest each year in order to pay full par value for the bond. Therefore, assuming that these three bonds have the same risk, which is consistent with them having the same market discount rate, the 4% bond offers a deficient coupon rate. The amount of discount below par value is the present value of the deficiency, which is 2% of par value each year. The present value of the deficiency discounted using the market discount rate is negative 8.425. When the coupon rate is less than the market discount rate, then the bond is priced at a discount below par value. When the coupon rate is greater than the market discount rate, the bond is priced at a premium above par value. When the coupon rate is equal to market discount rate, the bond is priced at par value. Yes. At this point, we have assumed that the bond value is priced on the coupon payment date. If the bond is between coupon payment dates, the price paid will include accrued interest, which is interest that has been earned but not yet paid. Accrued interest is discussed in detail in section 3.1. Equation 1 is a general formula for calculating a bond price given the market discount rate of such. The examples so far have been for an annual payment bond, which is the convention of most European bonds. Asian and North America bonds generally make semi-annual payments, and the stated rate is the annual coupon rate. Suppose the coupon rate on a bond is stated as to be 8%, and the payments are made twice a year or semi-annually on 15th of June and December. Then, yeah. If the actual par value of the bond investment in, for instance, is the price of such, then you just multiply it and plug it into the formula. It's quite straightforward. Yield to maturity. If the market price of a bond is known, equation 1 can be used to calculate its yield to maturity. The yield to maturity is the internal rate of return on the cash flow, the uniform interest rate, such that when the future cash flows are discounted at that rate, the sum of the present values equals the price of the bond. It is the implied market discount rate. The yield to maturity is the rate of return on the bond to an investor given three critical assumptions. The investors hold the bonds to maturity. The issuer makes all of the coupons and principal payments in the full amount on the scheduled date. Therefore, yield to maturity is the promised yield, and yield assuming the issuer does not default on any of the payments. The investor is able to reinvest coupon payments at the same yield. This is a characteristic of an internal rate of return. For example, suppose that a 4-year 5% annual coupon payment bond is priced at 105 per 100 par value. The yield to maturity is the solution for the rate R in this equation. Solving by trial and error search or using the time value of money keys on a financial calculator obtains the result that R equals 0.03634. The bond trades at a premium because its coupon rate of 5% is greater than the yield that is required by investors. Yields to maturity do not depend on the actual amount of par value in a fixed income portfolio. For example, suppose a Japanese institutional investor owns a 3-year 2.5% semi-annual payment bond having a par value of 100 million Japanese yen. The bond currently priced at such. So this is just an example. Relationship between bond price and bond characteristics. The price of a fixed rate bond will change whenever the market discount rate changes. For relationships about the change in bond price given the market discount rates are, the bond price is inversely related to the market discount rate. When the market discount rate increases, the bond price decreases. This is the inverse effect. For the same coupon rates, the time to maturity, the percentage price change is greater in absolute values, meaning without regards of signs of the change. When the market discount rate goes down, then when it goes up, the convexity effect. For the same time to maturity, the lower coupon bond has a greater percentage or price change than a higher coupon bond when their market discount rates change by the same amount. This is the coupon effect. And generally, for the same coupon rate, a longer term bond has a greater percentage price change than a shorter bond when their market discount rate changes by the same amount. this is the maturity effect. So these are just quite, quite logical, right, straightforward characteristics of bonds. The third relationship is the coupon effect. Consider bond A, B, and C, which have a 10-year of maturity. For both the decreases and increases in the yield to maturity, bond A has a larger percentage change than bond B, and bond B has a larger percentage than bond C. The same pattern holds for 20-year and 30-year bonds. Therefore, lower coupon bonds have a maturity price volatility than higher coupon bonds. After other things being equal, the fourth relationship is that maturity effect. Compare the results of bond A, D, B, E, and for bonds C and F, the 20-year bonds have a greater percentage price change than a 10-year bond. So this just makes a lot of sense. If you understand the equation, you can understand these characteristics without any problem. Exhibit 2 demonstrates the impact on a bond price, assuming that the time to maturity does not change. It is shown as instantaneous change in a market discount rate from one moment to the next, but bond prices change as time passes, even if the market discount rate remains the same. As time passes, the bondholders come closer to receiving the par value at maturity. The constant yield price trajectory illustrates the change in the price of a fixed income bond over time. The trajectory shows the pull to par effect on the price of a bond trading at the premium or a discount to par value. If the issuer does not default, the price of a bond approaches par value as its time to maturity approaches 0. Pricing bonds with spot rates. When a fixed rate bond is priced using a market discount rate, the same discount rate is used for each cash flow. A more fundamental approach to calculate the price of a bond is to use a sequence of market discount rates that corresponds to cash flow dates. These market discount rates are called spot rates. Spot rates are yields to maturity on zero coupon bond maturing at the date of each cash flow. Sometimes they are called zero rates. Bonds price or value determined using the spot rate is sometimes referred to as the bonds or no arbitrage value. If a bond's price differs from its non-arbitrage value, an arbitrage opportunity exists in the absence of a transaction costs. Suppose that the 1-year spot rate is 2% and the 2-year spot rate is 3% and a 3-year spot rate is 4%, then the price of a 3-year bond that makes a 5% annual coupon payment is 102.960. Okay. Prices and yields conventions for quotes and calculations. When investors purchase shares, they pay the quoted price for bonds. However, there can be a difference between the quoted price and the price paid. This section explains why this difference occurs and how to calculate the quoted price and the price that will be paid. It also describes how prices are estimated for bonds that are not actively traded, and demonstrates how yield measures are calculated for fixed rate bonds, floating rate notes, and money market instruments. A flat price, accrued interest, and full price. When a bond is between coupon payment dates, its price has two parts: the flat price, or the PV flat, and the accrued interest, the AI. The sum of the parts is the full price of the PV full, which also called the invoice or the dirty price. The flat price, which is the full price minus the accrued investment, is called the quoted clean price. So that makes a lot of sense. The flat price usually is quoted by bond dealers. If a trade takes place, the accrued interest is added to the flat price to obtain a full price paid by the buyer and received by the seller on the settlement date. The settlement date is when the bond buyer makes cash payments and the seller delivers the security. The reason for using a flat price for quotation is to avoid misleading investors about market prices, about the market price trends for the bond. If the full price were to be quoted by dealers, investors would see the price rise day after day, even if the yield to maturity did not change. This is because the amount of accrued interest increases each day. Then, after the coupon payment is made, the quoted price would drop dramatically. Using the flat price for quotation avoids that misrepresentation. If it is the flat price that is pulled to par along the constant yield price trajectory as shown in Exhibit 3. Okay, so that's just characteristics of the bond. Matrix pricing. Some fixed rate bonds are not actively traded, therefore there is no market price available to calculate the rate of return required by investors. The same problem occurs for bonds that are not yet issued. In these situations, it is common to estimate the market discount rate and price based on the quoted or flat price of more frequently traded comparable bonds. These comparable bonds have similar times to maturity coupon rates, the credit quality. These estimations process is called the matrix pricing. For example, suppose that an analyst is using, so this is just an example. Okay. Matrix pricing also is used to in underwriting new bonds to get an estimate of the required yield spread over the benchmark rate. The benchmark rate typically is the yield to maturity on a government bond having the same or close to the same time to maturity. The spread is the difference between the yield to maturity on the new bond and the benchmark rate. The yield spread is the additional compensation required by investors for the difference in the credit rating, liquidity risk, and tax status of the bond relative to the government bond. This spread is sometimes called the spread over the benchmark. The spread over the benchmark. Yield spreads are often stated in terms of basis points, BPS. Whereas basis points equals the 1/100th of a percentage point. For example, if a yield of maturity is 2.25% and benchmark rate is 1.5%, then the yield spread is 0.75% or 75 BPS. So multiplied by 100. There usually is a different yield spread for each maturity and for each credit rating. The term structure of a risk-free rate, which is discussed further in section 4, is the relationship between yields to maturity on risk-free bonds and times to maturity. The quotation marks around risk-free indicate that no bonds is truly without risk. The primary component of yield spread of many bonds is compensation for a credit risk, not for time to maturity, and as a result, the yield spread reflects the term structure of credit spreads. The term structure of credit spreads is the relationship between the spread over the risk-free or benchmark rates and times to maturity. These terms structures are covered in more detail in later readings. The issuer now has an estimate of the 4-year yield spread. 226 BPS. This spread is a reference point to estimating 5-year spreads in newly issued bonds. Okay. Yield measures for fixed rate bonds. There are many ways to measure a rate. Oh wait, hold up. The rain is getting quite large. I should go close the window real fast. Alright, I closed the window so the water doesn't get in my house. There are many ways to measure the rate of return of a fixed rate bond investment. Consider a 5-year zero coupon rate bond. The purchase price today is 80, and the investor will receive a £100 redemption in 5 years, which is 25% gain. However, the investor wants a yield measured in a standardized measure that is standardized to allow comparison between bonds that have different times to maturity. Therefore, yield measure typically are annualized. A possible annual rate is a bond of 5% per year, which is divided by 5. In general, an annualized and compounded yield on a fixed rate bond depends on the assumed number of periods in a year, which is called the periodically of the annual rates. Typically, the periodically matches the frequency of coupon payments. A bond that pays semi-annual coupons has a stated annual yield to maturity for the periodically of 2. The rates per semi-annual period times 2. A bond that pays quarterly coupons has a stated annual yield of periodically of 4. So that's really simple, just straightforward calculations. In this zero coupon bond example, a 2.2565% compounded 2 times a year. That's divided by 2. You divide it by 12. You get that. Okay. The most common periodicity For USD denominated bond yields is 2 because most bonds in the US dollar market make semi-annual coupon payments. An annual rate having a periodicity of 2 is known as a semi-annual bond basis yield or a semi-annual bond equivalent yield. Therefore, the semi-annual bond basis yield is the yield per semi-annual period times 2. It is important to remember that semi-annual bond basis yield and the yield per semi-annual period have different meanings. For example, if a bond yields a 2% semi-annual period, its annual yield is 4% when stated on a semi-annual bond basis. An important tool used in fixed income analysis is to convert an annual yield from one periodicity to another. These are called periodicity or compounding conversions. A general formula to convert an annual percentage rate for m periods per year, denoted as APRM, is the annual percentage rate of n periods per year. APRN is equation 7. An important concern for quoting and calculating bond yields to maturity is the actual timing of the cash flows. Consider a 6% semi-annual payment corporate bond that matures on 15th of March 2022. Suppose that the settlement on 23rd of January 2014. The bond is priced at 89.5 per 100 of par value to yield 6.236%. Quoted on semi-annual bond basis. Its coupon payments are scheduled for 15th of March and 15th of September of each year. The yield calculation implicitly assumes that the payments are made on these dates, neglects the reality that the 15th of March 2015 is a Sunday and 15th of September 2018 is a Saturday. In fact, coupon payments will be made to investors on the following Monday. Yield measures that neglect weekends and holidays are quoted on what it has a street conversion. The street conversion yield to maturity is the internal rate of return of the cash flow, assuming that payments are made on the scheduled dates. Okay. Let me drink. Today I'm drinking peach oolong tea. If a fixed rate bond contains an embedded option, the yield measures are used. The embedded option is part of a security and cannot be removed and sold separately. For example, a callable bond contains an embedded call option that gives the issuer the right to buy the bond back from investors for a specified price on predetermined dates. The present dates usually coincide with coupon payment dates after a call protection period. The call protection period is the time during which the issuer of the bond is not allowed to exercise the call option. Suppose that a 7-year 8% annual coupon payment bond is first callable in 4 years. That gives the investor 4 years of protection against bonds being called. After the call protection period, the issuer may exercise the call option. If lower interest rates decrease, the issuer's credit quality improves. Okay, so each calculation is based on equation 1, and equation 1 is this. The previous equation 1. Whereby the call price per value is used for future value. The lowest of the sequence of the yields to call and the yields to maturity is known as the yields to worst. In this case, the yields of the third call is on 6.953%. The intent of the yield measure is to provide to the investors the most conservative assumption for the rate of return. The yield to worst is a commonly cited yield measure for fixed rate callable bonds used by bond dealers and investors. However, a more precise approach is to use an option pricing model and an assumption about future interest rates volatility for value. The embedded call option. The value of the embedded call option is added to the flat price of the bond to get an option adjusted price. The investor bears the call risk. So the embedded call option reduces the value of the bond from an investor's perspective. The investor pays a lower price for the callable bonds than if it were option free. If the bond were non-callable, its price would be higher. The option-adjusted price is used to calculate the option-adjusted yield. The option-adjusted yield is the required marked discount rate whereby the price is adjusted for the value of the embedded option. The value of the call option is the price of the option-free bond minus the price of the callable bond. Yield measures for floating rate notes. The floating rate notes are very different from a fixed rate bond. The interest payments on a fixed floating rate note, which often is called a floater or FRN, is not fixed. Instead, they vary from period to period depending on the current level of a reference interest rate. The interest payments can go up or down. This is why they float. The intent of the FRN is to offer the investor a security that has less market price risk than a fixed rate bond when the market interest rates fluctuate. In principle, a floater has a stable price even in the period of volatile interest rates. With a traditional fixed income security, interest rate volatility affects the price because the future cash flows is constant. With a floating rate note, interest rate volatility affects future interest payments. The reference rate on a floating rate note usually is a short-term money market rate, such as 3-month LIBOR. The principle of a floater typically is non-amortizing and is redeemed in full at maturity. Okay. Yield measures for money market instruments. Money market instruments are short-term debt securities. They range in time to maturity from overnight sales to repurchase agreements or repos to 1-year bank certificates of deposits. Money market instruments also include commercial papers, government issues of less than 1 year, bankers' acceptances, and time deposits based on such indexes as LIBOR and Euribor. Money market mutual funds are major investors in such securities. These mutual funds can invest only in certain eligible money market securities. There are several important differences in yield measures between the money markets and the bond markets. Bond yields to maturity are annualized and compounded. Yield measures in the money markets are annualized but not compounded. Instead, the rate of return on the money market instruments is stated on the simple interest basis. Bond yields to maturity can be calculated using standard time value of money analysis and with formulas programmed into the financial calculator. Money market instruments often are quoted using non-standard interest rates and require different pricing equations than those used for bonds. Bond yields to maturity usually are stated for a common periodicity for all times to maturity. Money market instruments have different times to maturity, have different periodicities for annual rates. In general, quoted money market rates are either discount rates or add-on rates, although market conversion rates vary around the world. Commercial papers, treasury bills, and bankers' acceptance offers are quoted at a discount rate basis. Bank certificates of deposit or repos and such indexes of LIBOR and Euribor are quoted on the add-on rate basis. It is important to understand that discount rates has a unique meaning in the money market. In general, discount rates means interest rates used to calculate a present value, for instance, market discount rate, as used in the reading in the money market. However, discount rates is a specific type of quoted rate. Some examples will clarify this point. Yes. Okay. Maturity structures and of interest rate. There are many reasons why the yield to maturity on two bonds are different. Suppose the yield to maturity of bond X and bond Y. The following are some possible reasons for the difference between the yields. The currency. Bond X can be denominated in a currency with a higher expected rate of inflation than currency of bond Y. Credit risk. Bond X has a non-investment grade rating of BB, and bond Y has an investment grade rating of AA. Liquidity. Bond X can be liquid and bond Y can be actively traded. Tax status. Interest income on bond X can be taxable, whereas interest income on bond Y can be exempt from taxation. periodicity, bond X could make a single annual coupon payment and its yield to maturity could be quoted for periodicity of 1. Bond Y can make monthly coupon payments and its yields to maturity can be annualized for periodicity of 12. Obviously, another reason that is that bond X and bond Y could have different times to maturity. This factor explaining the differences in yields is called the maturity structure or term structure of interest rates. It involves the analysis of yield curves, which are relationships between yield to maturity and time to maturity. There are different the different types of yield curves depending on the characteristics of underlying bonds. In theory, maturity structures should be analyzed for bonds that have the same properties other than time to maturity. The bonds should be denominated in the same currency and have the same credit risk, liquidity, and tax status. Their annual rates should be quoted at the same for the same periodicity. Also, they should have the same coupon rate so that they each have the same degree of coupon reinvestment risk. In practice, maturity structure is analyzed for bonds for which these strong assumptions really hold. The ideal data set would be yields to maturity on a series of zero coupon government bonds for a full range of maturities. This data set is the government bond spot curve, sometimes called the zero or the strip curve. The spot zero or strip curve is a sequence of yields to maturity on zero coupon bonds. Often these government spot rates are interpreted as a risk-free yield in the context of risk-free, referring only to default risk. There are still could be significant risk among inflation risk and the liquidity risk. So there is no real risk-free rate of return, not because the bond would not default. Obviously, if the U.S. Treasury bond defaults, you have bigger problems to worry about than your own bond. But they're talking about the other risk, the inflation risk, the liquidity risk, etc. Yeah, so this is what it looks like. The spot curve is upward sloping and flattens for long times to maturity. Longer term bonds usually have a higher yield than shorter term bonds. These patterns typically normal under market conditions. Sometimes a spot curve is downwards sloping in that the shorter term yields are higher than longer term yields. This downward sloping spot curve is called an inverted yield curve. The theories that attempt to explain the shape of the yield curve and its implications for future financial markets is considered in a later reading. The hypothetical spot curve is ideal for analyzing maturity structures because it best meets the other things being equal assumptions, as government bonds presumably have the same currency, credit risk, liquidity, and tax status. Most importantly, they have no coupon reinvestment risk because there are no coupons to reinvest. Governments, however, most actively traded government and corporate bonds make coupon payments. Therefore, analysis of maturity structure usually is based on price data on government bonds that make coupon payments. These coupon bonds might not have the same liquidity and tax status. Older seasoned bonds tend to be less liquid than newly issued debt because they are owned by the bonds and hold institutional and retail investors. Governments issue new debt for regular time to maturity, for instance, 5 years and 10-year bonds. The current 6-year bonds could be a 10-year bond that was issued 4 years ago. So yeah, that makes sense. Exhibit 6, so this is what it shows, Exhibit 6. Exhibit 6 also includes yields for short-term government securities having 1 month to 3 months, 6 months, and 12 months to maturity. Although these money market instruments might have been issued and traded on a discount rate basis, they typically are reported as bond equivalent yields. It is important for an analyst to know whether they have been converted to the same periodicity as the longer-term government bond or not. The observed yield curve can be misleading because the number of periods in the same year are not the same. In addition to the yield curve on the coupon bond and a spot curve to zero coupon bonds, maturity structures can be assessed using a par curve. A par curve is a sequence of yields to maturity that such that each bond is priced at par value. The bonds, of course, are assumed to have the same currency, credit risk, liquidity, tax status, and annual yields stated for the same periodicity between coupon payment dates, and flat price is assumed to be equal to the par value. Fixed income securities covered so far have been cash market securities. Money market securities is often settled on the same day or cash settlement basis. Other securities have differences between the trade dates and the settlement dates. For instance, the government bond trades on T+1 basis. There is a 1 day difference between the trade dates and the settlement dates. If a corporate bond trades at T+3 basis, the seller delivers the bond and the buyer makes payments in 3 business days. Cash markets are also called spot markets, which can be confusing because spot rates can have 2 meanings. It can mean the rate on a bond traded in the spot or cash market. It can also mean the yield on a zero coupon bond, which is the meaning of spot rate used in this reading. A forward market is a future delivery beyond the usual settlement time period in the cash market. Argument to the term for the transaction is to the trade date, but the delivery of the security and payment of its deferred to the future date. A forward rate is the interest rate on a bond or money market instruments traded on a forward market. For example, suppose that it can that the cash market, a 5-year zero coupon bond, is priced at 81 per 100 of par value, is a yield to maturity of 4.2592% stated on semi-annual bond basis. Suppose that a dealer agrees to deliver 5-year bonds 2 years into the future for a price of 75 per 100 of par value. The credit risk, liquidity, and tax status of this bond traded in the forward market is the same as one in the cash market. The bond rate is 5.8372%. Notation of the forward rate is important to understand. Although finance textbooks use varying notations, the most common market practice is the forward rate of the 2Y5Y. This is pronounced the 2-year into 5-year rate, or the simply 2s5s. The idea in that the first number, the 2-year, refers to the length of the forward period in the year, and from today to the second number, the 5-year, refers to the tenure of the underlying bond. The tenure is the time to maturity for a bond. Therefore, a 5.8272% is a 2Y5Y, or the 2-year into 5-year rate. Forward rate for zero coupon bonds, the 5-year yield 2 year into the future. Note that the bond that will be a 5-year 0 in 2 years currently has a 7-year to maturity. In the money market, the forward rate usually refers to the months. For instance, the analyst might inquire about a 1M 6M forward rate for Eurobor, which is a 6 months Eurobor 1 month into the future. Implied forward risk, are calculated from spot rates, and implied forward risk is a break-even reinvestment rate. It links the return on an investment into in a short-term zero coupon bond to the return on an investment in a longer-term zero coupon bond. Okay, so this is what it looks like. A forward rate can be interpreted as an incremental or marginal return for extending the time to maturity for an additional time period. Suppose an investor has a 4-year investment horizon and is choosing between buying 3-year zero coupon bonds that is priced at yield 3.65% and a 4-year zero that is priced at to yield 4.18%. The incremental or marginal return for a 4th year is 5.778%. The 3Y1Y implies forward rates. If the investor views the future bond yields, is that the 1-year yield in 3 years is likely to be less than 5.778%, the investor might prefer to buy the 4-year bond. However, if the investor views is that the 1-year yield would be more than the the implied forward rate, the investor might prefer the 3-year bond and the opportunity to reinvest at the expected higher rates. Explains why an implied forward rate is the break-even reinvestment rate. Implied forward rates are very useful to investors as well as bond issuers to making maturity decisions. The forward curve has many applications in fixed income analysis. Forward rates are used to make maturity choice decisions. They are used to identify arbitrage opportunities between transactions in the cash market for bonds and in the derivative markets. Forward rates are important in the valuation of derivatives, especially interest rate swaps. For options, these applications for the forward curve are covered in the other readings. Forward rates are used to value a fixed income security in the same manner as spot rates because they are interconnected. The spot curve can be calculated from the forward curve, and the forward curve can be calculated from the spot curve. Either curve can be used to value a fixed rate bond. An example will be illustrated in this process. Suppose the current forward curve for 1-year rates are as follows, as such. Yeah. Yield spreads. A yield spread is in general is the difference in the yield between different fixed income securities. This section describes a number of yield spread measures. Yield spreads over benchmark rates in fixed income securities analysis. It is important to understand why bond prices and yields to maturities change. To do this, it is useful to separate a yield to maturity into two components, the benchmark and its spread. The benchmark yield for a fixed income security with a given time to maturity is the base rate. Often a government bond yield. The spread is the difference between the yield to maturity and the benchmark. Okay. Frequently used benchmarks for floating rate notes such as LIBOR as a composite of interbank rates is the risk-free rate. The yield spread over the specific benchmark is referred to as the benchmark spread. It is usually measured in basis points. If no benchmark exists for a specific bond's tenure or a bond has an unusual maturity interpretation is used to derive an implied benchmark. Also, bonds with very long tenures are priced over the longest available benchmark bond. For example, 10-year bonds, often called century bonds in the U.S., are priced over a 30-year U.S. Treasury benchmark rate. Okay. Yield spread calculations. Okay. Summary. This reading covers the. Okay, let me see how long the summary is. Okay, this reading covers the principles and techniques that are used in the valuation of fixed rate bonds, as well as floating rate notes and money market instruments. These building blocks are used extensively in fixed income analysis. The following are the main points made in this reading. The market discount rate is the rate of return required by investors given the risk of the investment on the bond. A bond is priced at a premium above par value when the coupon rate is greater than market discount rate. A bond is priced at a discount rate below par value when the coupon rate is less than the market discount rate. The amount of any premium or discount is the present value of the excess of the deficiency of the coupon payment relative to the yield to maturity. The yield to maturity, the internal rate of return of the cash flow, is the implied market discount rate given the price of the bond. A bond price moves inversely with its market discount rate. The relationship between a bond price and its market discount rate is convex. The price of a lower coupon bond is more volatile than the price of a higher coupon bond, other things being equal. Generally, the price of a longer-term bond is more volatile than the price of a shorter-term bond, other things being equal. An exception to this phenomenon can occur on low coupons, bonds that are priced at a discount to par value, assuming no defaults. Premium and discount bond prices are pulled to par as maturity nears. A spot rate is the yield to maturity on a zero coupon bond. Yield to maturity can be approximated as the weighted average of the underlying spot rates. Between coupon dates, the full or invoice or dirty price of a bond is split between the flat, the quoted, and clean price of the accrued interest. A fixed price are quoted to not misrepresent the daily increases in the full price as a result of interest accruals. Accrued interest is calculated as a proportional share of the next coupon payments using either the actual or this is the same word. Actual or actual 330 over 360 method to count days. Matrix pricing is used to value illiquid bonds by using prices and yields on comparable securities having the same or similar credit risk, coupon risk, and maturity. The periodicity of an annual interest rate is the number of periods in the year. A year quoted, yield quoted on the semi-annual bond basis is an annual rate of a periodicity of 2. It is the yield per semi-annual period times 2. The general rule for periodicity conversions is the compounding more frequently at a lower annual rate corresponding to the compounding less frequently at a higher annual rate. Street conversion yields assume payments are made on scheduled dates, neglecting weekends and holidays. The current yield is an annual coupon payment divided by the flat price, thereby neglecting as a measure of an investor's rate of return the time value of money, any accrued interest, and the gain from buying at a discount, and the loss of buying at a premium. The simple yield is like the current yield, but includes the straight line amortization and the discount of premiums. The yield to worst is the callable bond. On the callable bond is the lowest of the yield to first call, yield to second call, and so on. Calculations calculated using the call price for the future value and the call date of the number of periods. The option adjusted yield on the callable bonds is the yield to maturity after adding the theoretical value of the call option to the price. A floating rate note or floater or FRN maintains. It sounds awful like a FRM, like financial risk management, is another certificate similar to the CFA. Anyways, maintains a more stable price than a fixed rate note because interest payments adjust for changes in market interest rates. The quoted margin on a floater is typically the specified yield spread over or under the reference rate, which is often the LIBOR. The discount margin on a floater is the spread required by investors and to which the quoted margin must be set. For the FRN, to trade at par value on a rate reset date, money market instruments having 1 year or less time to maturity are quoted on a discount rate or add-on rate basis. Money market discount rates understate the investor's rate of return because the interest income is divided by the face value of the total amount redeemed at maturity and not by the amount of the investment. Money market instruments need to be converted to a common basis for analysis. A money market bond equivalent yield is an add-on rate for 365-day year. The periodicity of money market instruments is the number of days in a year divided by the number of days to maturity. Therefore, money market instruments with different times to maturity have annual rates for different periodicities. In theory, the maturity structure or term structure of an interest rates is the relationship between yields to maturity and times to maturity on bonds having the same currency, credit risk, liquidity, tax, status, and periodicity. Spot curve is a series of yields to maturity on non-coupon bonds. A frequently used yield curve as a series of yields to maturity on coupon bonds. A par curve is a series of yields to maturity assuming the bonds are priced at par value. In a cash market, the delivery of the security and cash payment is made on a settlement date within a customary time period after the trade date. For example, T+3. In a forward market, the delivery of securities and cash payments is made on a predetermined future date. Forward rate is the interest rate on a bond or money market instrument traded in a forward market. An implied forward rate or forward yield is the break-even and reinvestment rate linking their return on an investment in a shorter term zero coupon bond to a return of an investment in a longer term zero coupon bond. An implied forward curve can be calculated from a spot curve. Implied spot rates can be calculated as geometric averages of forward rates. A fixed income bond can be valued using a market discount rate, a series of spot rates, or a series of forward rates. A bond yield to maturity can be separated into a benchmark and a spread. Changes in benchmarks rates captures macroeconomic factors that affect all bonds in the markets: inflation, economic growth, foreign exchange rates, and monetary and fiscal policies. Changes in spread typically captures microeconomic factors such as a particular bond, such as credit risk, liquidity, and tax effects. Benchmark rates can usually yield to maturity on government bonds or fixed rates to interest rate swaps. G spread is the spread over under the government bond rates, and an I spread is a spread over or under an interest rate swap rate. The G spread or an I spread can be based on a specific benchmark rate or on rates interpolated from benchmark yield curves. The Z spread is based on the entire benchmark spot curve. It's the constant spread that is added to each spot rate, such as the present value of the cash payment. Cash flow matches the price of the bond. An option adjusted spread, or OAS, is on the callable bond is the Z spread minus the theoretical value of an embedded call option. Okay. If I am not wrong, this is the end of this section. So this is reading 52. Remember, the show notes are in the description. You guys just head to Amazon and you guys can get the show notes. Oh, no, it's not. Okay, so we're still in this section. Okay, so we'll be getting into reading 53 in the next section. I do hope my readings have been helpful, and you guys go and head on to Amazon to get your own show notes. I do hope to see you guys next time. Without further ado, goodbye.